Earlier today, the Beige Book survey was released. The Fed's path is clear, but the bond market has thrown us a curveball, and the stock market is not happy about it. The Fed's Beige Book points to modest growth in the U.S. economy. This by Bloomberg, U.S. economy expanded at a slight or modest pace across most regions since early April, and consumers push back against higher prices. This said by the Federal Reserve in their Beige Book survey. It's a survey that's released prior to the Federal Reserve meeting. It gives us tremendous insight into what the Federal Reserve is thinking. Now, the Fed's Beige Book, let's compare the statement released today versus the last statement in April to note any significant differences. In April, in terms of auto sales, notable buoyed by improved inventories and dealer incentives in some districts, but sluggish in others. This again is in regards to auto sales. Well, today's report, roughly flat overall. We've marked the text in red if it has any sort of like negative connotation, green if it's an improvement. So May is a little bit of a decline in the sentiment in terms of auto sales. In terms of tourism, in April, we said modest increase on average, but widely varied reports. In May, strengthened across much of the country with mixed outlooks for the summer season. In regards to manufacturing, April was not good, declined slightly with growth only in 3 districts. In May, the report was better, characterized as flat to up with declines in only 2 of the districts. In non-financial services, April looked better, slight increases in activity on average. In May, the demand rose, but there was mixed activity in the transportation services. In bank lending in April, it was flat overall. In May, it declined, constrained by tight credit standards and high interest rates. Residential construction looks good in both months, increased on a little on average, with most districts strengthening in April. In May, housing demand rose modestly, with single family construction increasing. And finally, non residential construction and commercial real estate, flat construction, slightly falling. In May, softened conditions amid supply concerns and elevated borrowing costs. So overall, we see somewhat of a decline in the conditions pointed out by the Beige Book survey. Overall, in April, they were cautiously optimistic on balance. In May, somewhat more pessimistic, with rising uncertainty and a greater risk to the downside. Well, here's today's change in the Treasury yields, and you'll notice in particular the mid maturities, the 5 year, the 10 year, up 7 basis points. Well, given the pessimism in the Beige Book, why are bond yields moving higher? Remember, bond yields tend to move in anticipation of higher or lower interest rates and future economic growth or lack thereof. The Beige Book was negative. Why are bond yields going up? This doesn't make sense. If the Beige Book is pessimistic, again, why are bond yields rising? Well, we also have to contend with consumer confidence. And that's what the bond market is looking at. This is from Tuesday. U.S. consumer confidence rebounds in May. This was a surprise to many, by the way, after 3 months of decline. This is from Market Watch. So this has really thrown a twist into the equation. The Beige Book was pessimistic. We would normally expect bond yields to decline, but the consumer confidence actually shot bond yields up higher. Bond yields are rising, anticipating the Fed won't cut rates, despite a weak Beige Book. From Yahoo Finance, and this is a really interesting read. You'll be surprised. Yahoo Finance actually has some very interesting articles from time to time. The stock market today, Dow leads stock market slide as rising treasury yields rattle nerves. In particular, they note stocks are sliding as investors contemplate a jump in U.S. bond yields after a government debt auction flopped, reflecting worries that the Federal Reserve will keep rates higher for longer. So essentially, what we're looking at is the bond market is reacting to the strong consumer confidence numbers. It's ignoring the Beige Book. And as a result, this made stocks very nervous. We're going to show you 2 reasons why these interest rates are so bad for the stock market. Now, here's a quick recap. This is the performance in the Treasury market in terms of the yield since May. In particular, notice the 5, 7, 10 year. These are the midterm maturity bonds. They have gone down since the last Federal Reserve meeting in May. Now, that's in anticipation the economy is starting to move to the downside. However, this stands in contrast to today's performance in the Treasury market, which is up. So it's bucking the trend. Bond yields are now rising again. Now, this is very interesting and I think probably very much overlooked. This is again from Yahoo Finance. This is from the Piper Sandler Chief Investment Strategist. They said higher rates are now a systemic problem for equities. He added, at this point, it's really hard to see equities going up without rates going down. That thesis played out over the course of May. Soft economic data pushed yields lower and stocks rallied to record highs. Let's say that again. The soft economic data pushed yields lower. That makes sense. Soft economic data means the Federal Reserve is more likely to cut rates, bond yields follow lower. And stocks like the idea there may be future lower rates, so they rally to new record highs. But recently, a spike in the 10-year Treasury yield to 4.6%, its highest level since May 2nd, has corresponded with a decline in the S&P 500 as investors are increasingly wary about the prospect of the Federal Reserve interest rate cuts this year. Now, high interest rates are bad for stocks for two primary reasons. Well, there's more reasons, but two we want to highlight here. Number one, it's obvious. Higher rates slow economic growth. Higher rates make it more expensive to take out loans, invest, that sort of thing. But number two, and I think is probably widely overlooked, higher bond yields also compete with the stock market returns. The S&P 500 over the past 100 years averages, 7 to 10%? Well, if you can get 5% in the U.S. Treasury, well, then maybe the incentive to buy stocks is really not there. Now the bond yields have gone from 4.5 to 4.6%. Maybe now we're looking at a situation where traders and investors don't see a lot of great things out of the stock market. They say, maybe I'll just take a little bit of a cut in yield and a lot more safety. So these higher yields in the bond market, because interest rates are so high, are really making stocks look very unattractive. And that's one of the primary reasons why the stock market was so weak today. In red, S&P 500. This is a long-term chart, couple years. In blue, this is a 10-year U.S. Treasury. And this paints the picture perfectly. As a 10-year bond goes up, stocks go down. The 10-year bond is moving up in anticipation the Federal Reserve will not cut rates. And as a result, the stock market doesn't like that. More recently, we've seen, again, a resurgence in stocks to the upside. S&P 500 in red goes up. The 10-year bond is going down in anticipation the Federal Reserve will cut rates soon. That was until very recently. But now we're seeing a spike in the 10-year. Again, 4.6%, the highest high since May 2nd. So if this chart follows suit, where do we think stocks may go? What does this mean moving forward? Well, now the market doesn't like strong data. Strong economic data means the Federal Reserve is less likely to cut rates, like the consumer confidence numbers, and that now is translating into weak stock prices. Now, this week's economic calendar, we've mentioned this already, is one of the most important weeks in a while because we have four key, very big events. And the Federal Reserve doesn't have all the time in the world to decide whether to cut rates or not, because essentially we're in an election cycle. And you can take the November meeting right off the table. The Fed cannot. Now, I know, we spoke about this the other day. Federal Reserve Chairman Jerome Powell says he will cut rates if it's necessary. He won't if it's not. But the fact of the matter is they don't want to make any kind of move right before an election. That would appear to be, somewhat political. So yesterday we spoke about the Case-Shiller Home Price Index. Actually, very revealing what the data did show us. Today is the Beige Book. Next, we have GDP, and of course, that ever important PCE, personal consumption expenditure. Again, yesterday we spoke about the home prices, but they're rising, but for all the wrong reasons. They're rising as a result of inflation. They're rising as a result of a tiny amount of supply within the existing home sales inventory. And we dove into the details, into the data in this particular video. And I think that you'll find what we discovered here to be quite interesting.